All right, everyone, welcome. As you all get settled into your careers in business administration, you're going to find yourselves making really critical decisions pretty much every single day. But what are those decisions based on? Gut feelings? Well, hopefully not. Today, we're going to dive into the engine that powers those big decisions, the fundamental language of business itself. And let me be clear, this isn't about just crunching numbers for the sake of it. No, it's about learning how to read the story that those numbers are telling us. We are going to break down the accounting cycle piece by piece.
So just think about that for a second. How does something as simple as one person buying a cup of coffee, how does that single event eventually transform into the kind of high-level intelligence a company needs to decide whether to open 100 new stores across the country? Well, the bridge connecting that one tiny transaction to a massive corporate strategy, it isn't magic. It's a really rigorous, systematic process. And that process is exactly what we're here to dissect today. So let's get formal for a moment. What exactly is the accounting cycle? Well, the textbook definition says it's the process for handling financial transactions. But let's reframe that, because that's a little dry. Think of it less as a process and more as an engine. You see, this engine takes in the raw fuel of daily business, every sale, every purchase, every single payment, and through a series of very structured steps, it refines that fuel into the energy that powers smart decisions. Now, that phrase over a specific period is absolutely critical. This isn't a one-and-done thing. It's a consistent rhythm, monthly, quarterly, annually, that lets us measure performance over time and tell a coherent, logical story. So why do we go through all this trouble? Why is this cycle so fundamental? Honestly, it all comes down to trust. Think about it. Consistency means that investors can actually compare your company's performance this quarter to the last quarter and have it mean something. Transparency gives stakeholders, like banks or regulators, a clear, honest window into your financial health. And most importantly for all of you, reliability ensures that when you're in a leadership position, you are making your calls based on solid, verifiable facts, not just a hunch.
Okay, so we've established the why. We get it. It's important. Now let's get our hands dirty and explore the how. We're going to break down this engine into its 4 core components. You'll see how each one logically builds on the one before it, and how we actually move from just raw, chaotic data to genuinely actionable insight. Here they are, the 4 core steps. First, we record every single transaction. This is the bedrock. Data integrity starts here. Second, we make what are called adjusting entries, and this is a critical step, as we'll see, from making sure our timing is accurate. Third, we prepare the financial statements. This is the payoff, where all that raw data gets synthesized into powerful intelligence. And finally, we close the books, which basically means we reset the system to get ready for the next period. Let's dive deep into each one of these.
Step 1 is the absolute foundation, recording transactions. Every single financial event, and I mean every event, no matter how small it seems, has to be captured. A $5 sale of a coffee, a $20 purchase of office supplies, each one is a transaction that gets recorded in what's called a journal. You have to understand, an error right here at this initial stage, a missed entry or maybe a number typed in wrong, that single mistake will cascade through the entire cycle. It will compromise the integrity of every single step that follows and ultimately the decisions that are based on that bad data. It's the classic garbage in, garbage out principle, and it starts right here.
Okay, now we get to a really critical part of the cycle, and honestly, one that's often misunderstood. Let's imagine your consulting firm finishes a huge project for a client in December. You've done the work, you've earned the revenue, but the client's payment terms say they have until February to actually pay you, so you won't see that cash for 2 months. Now, here's the crucial question. In which month did you actually earn that money? Was it December, when you did the work, or February, when the cash finally hit your bank account? Step 2 is what gives us the answer. And this leads us to a true cornerstone of modern accounting, the accrual basis. This is a fundamental concept. It's completely different from what we call cash basis accounting, which, well, it only records transactions when cash physically changes hands. Accrual accounting, on the other hand, recognizes revenue when it is earned and expenses when they are incurred. And this is key, regardless of when the cash actually moves. The special journal entries we make, called adjusting entries, are what allow us to do this. So in our consulting example, we would make an adjusting entry to recognize that revenue back in December because that's when we did the work. This aligns our financial records with our actual business activity, and it gives a much more accurate picture of how the company really performed during that period. So after all that meticulous work of recording and adjusting and getting the timing just right, we finally reach the culmination of the cycle. This is where we transform all of that raw data into the most critical documents in the business world. These reports are what will narrate your company's financial story to the world.
These are the big three. First up, the income statement. Think of this like a video of your business's performance over a period of time. It answers the simple, vital question, were we profitable? It does this by matching the revenues we earned with the expenses we incurred to generate them. The result? Net income. Next, the balance sheet. If the income statement is a video, the balance sheet is a snapshot, a photo taken at a single point in time. It shows what the company owns, which are its assets, what it owes, its liabilities, and the owner's stake, which is equity. It's all governed by that fundamental accounting equation. Assets equal liabilities plus equity. It always has to balance. And finally, we have the cash flow statement. I like to think of this one as a detective. It investigates how the net income from the income statement connects to the actual change in cash on the balance sheet. It breaks down all the cash movements into operating, investing, and financing activities, and it gives you crucial insight into your company's liquidity. And remember this, a profitable company can absolutely go bankrupt if it mismanages its cash. This statement shows you exactly how and why.
All right, we've gone through a lot of the mechanics, the how-to, but now let's bring this all back to the big picture. As students of business administration, why is a deep, fundamental understanding of this cycle so incredibly crucial for your future? Because this right here, this is the engine that will power every significant, high-stakes decision you make throughout your entire career.
This slide just perfectly illustrates the two different worlds of decision-making. On one side, you've got a manager just operating on intuition, right? I feel like we're doing pretty well this quarter. Let's hire a couple more people. That is pure guesswork. It's a gamble. On the other side, you have a leader who uses the financial statements to make an informed, strategic decision. They're saying, okay, our income statement shows consistent revenue growth. Our balance sheet confirms a healthy debt-to-equity ratio. And our cash flow statement shows we can absolutely support the new salaries. The data supports this expansion. You see the difference? One is a shot in the dark. The other is a calculated, strategic move.
And this brings us to what is easily the most common mistake I see from students, and frankly from new entrepreneurs, confusing cash with profit. It is so tempting to look at a healthy bank balance and think your business is a success. But let's apply that accrual principle we just learned. You might have $100,000 cash in the bank, which feels great. But what if you've also incurred $120,000 in expenses this month that just haven't been paid yet? Are you profitable? No, absolutely not. You're $20,000 in the hole. Relying on your bank balance alone is incredibly misleading. Only the full accounting cycle can give you the true, complete financial picture.
So, let's end with this thought. The accounting cycle, it's not just some boring set of rules you have to memorize for an exam. It is the language of business. It gives you the grammar, the vocabulary, and the structure you need to write a clear, compelling, and truthful story about an organization's journey, its struggles, its successes, its potential. As you move forward in your careers, you will be the authors of these stories. Mastering these principles gives you the power to tell a story of sustainable growth, of stability, and of real success. So the real question is, what story will you tell?